Hello, and welcome back to Bonnie's Life, your home for deep, honest, and data-driven dives into the world of cryptocurrency. It is Friday, February the 6th, 2026, and what a week it has been. If you have been watching the charts this week, you know exactly what I'm talking about. We have seen a spectacular crash, billions of dollars in liquidations, and a market sentiment so fearful it is practically hiding under the bed. Today, we are going to dissect this roller coaster week day by day, see how our past predictions held up, assign a reliability score to our analysis, and most importantly, equip you with the crucial triggers you need to navigate this volatile weekend. So grab your coffee, settle in, and let us get into it. And before we dive into the daily review, let me set the stage. The total cryptocurrency market capitalization has fallen from its October 2025 peak of $4.38 trillion to approximately $2.25 trillion as of this morning. That is a staggering decline of nearly 49%. Since the start of 2026 alone, the market has shed an average of $20 billion per day, according to data from Finbold. Bitcoin dominance currently sits at 56.8%, while Ethereum dominance has dropped to just 10%. These are not just numbers on a screen. These represent real money, real portfolios, and real consequences for millions of investors around the world. Let us start our daily review on Monday, February the 2nd. The week began with a sense of unease hanging over the market like a dark cloud. Bitcoin opened the week trading around $78,768, according to CoinGecko closing data. Ethereum was at $2,344, and Solana was holding at $104.52. The big news that set the tone for the entire week was the nomination of Kevin Walsh as the next Federal Reserve Chair. Now, for those of you who do not follow traditional finance closely, let me explain why this matters. Walsh is known for his aggressive stance on reducing the Federal Reserve's balance sheet, a process known as quantitative tightening. This essentially means sucking liquidity out of the financial system. And as Binance Research pointed out in their weekly commentary, crypto assets sit at the very end of the liquidity chain. When liquidity tightens, crypto is the first to be sold to meet margin calls across traditional portfolios. On Monday, Reuters reported that $2.56 billion in Bitcoin positions had already been liquidated in the days leading up to this point. The writing was on the wall. Tuesday, February the 3rd, saw the slide continue and intensify. Bitcoin dropped to $75,639, a decline of nearly 4% from Monday. Ethereum fell to $2,226, and Solana slid to $97.62. The narrative of a crypto winter started to gain serious traction in the media. CoinDesk reported over $740 million in crypto liquidations in just 24 hours, with the majority coming from long positions. This tells us that traders who were betting on prices going up were getting absolutely hammered. The deleveraging process had officially begun. What made Tuesday particularly wild was the intraday volatility. Bitcoin briefly touched a 14-month low before staging a sharp rally, only to give back those gains by the end of the day. This kind of whipsaw action is a classic sign of a market in distress, where neither bulls nor bears have control. Wednesday, February the 4th, was another brutal red day. Bitcoin tumbled further to $73,172. Ethereum dropped to $2,152, and Solana fell to $92.29. According to Binance Square data, another $520 million in cryptocurrency futures were liquidated. The fear was palpable across every trading desk and every crypto community online. Bitcoin had now broken below its 100-day and 200-day moving averages, which are critical technical indicators that many institutional traders watch closely. It also broke below the head and shoulders neckline pattern that had been forming since late 2025. The Binance research team noted that Bitcoin touched an intraday low of $72,950 on Wednesday, the lowest level since November 2024. The next key support level was identified at $70,000, a level that was tested multiple times throughout 2024 and only broke out in November when the probability of Trump's election victory increased. Then came Thursday, February the 5th. This was the day of the Great Capitulation. I want you to really understand the magnitude of what happened on this day. Bitcoin plummeted to a closing price of $62,854, a single-day decline of over 14%. Ethereum collapsed to $1,820, a drop of over 15%. Solana crashed to $78.50, down over 15% as well. XRP lost more than 10% overnight after being weighed down by $30 million worth of liquidations, according to CoinDesk. In total, CNBC reported that more than $2 billion worth of long and short positions on crypto were liquidated on Thursday alone, according to CoinGlass data. The Fear and Greed Index, which measures the overall sentiment of Bitcoin investors, plunged to a reading between 5 and 9, depending on the source. This is deep within the extreme fear zone and represents the lowest level since the collapse of FTX in the summer of 2022. Bitcoin's Relative Strength Index, or RSI, dropped to 17. To put that in perspective, that is the third most oversold reading in Bitcoin's entire modern history. It has only been exceeded twice before. The Bitcoin Implied Volatility Index hit 88.55, approaching the levels seen during the FTX collapse when it peaked at 105. Over 570,000 traders were hit by liquidations, and the total crypto market cap had lost over $1 trillion since mid-January. But then, something remarkable happened on Friday today. Just when it seemed like all hope was lost, the market started to rebound. Bitcoin climbed back up to around $67,000, recovering from an intraday low of approximately $61,000. Ethereum bounced back to around $1,850. Solana recovered to the $85 to $92 range. And here is the surprise of the day. XRP surged an incredible 20.1%, leading the entire CoinDesk 20 index, with HBAR following at a 13.1% gain. According to CoinDesk's performance update, all 20 assets in their index were trading higher on Friday. The tech sector also stabilized, with Wall Street poised to open with gains. It appears that the extreme oversold conditions finally triggered a wave of buying. As the mid-rate weekly forecast put it, the worst may be behind us. But is it really? Now let us talk about the accuracy of our predictions from this week. We had anticipated a period of consolidation and potential downside, and we correctly identified the key resistance levels and the risk of a liquidity-driven sell-off. However, the severity and speed of the crash were significantly greater than we expected. Our Monday analysis flagged the wash nomination as a risk factor, which proved to be the primary catalyst. We correctly predicted that Ethereum and Solana would underperform Bitcoin in a risk-off environment. However, we underestimated the magnitude of the Thursday capitulation event. Taking all of this into account, I would assign our weekly predictions an accuracy score of approximately 65%. We got the direction right, we got the triggers right, but we underestimated the intensity. The main lesson here is that when macro forces align against crypto, the moves can be far more violent than historical averages suggest. Let me now address what came out differently than expected and what the impact has been. The biggest surprise was the sheer scale of the deleveraging event. Binance research data shows that the aggregate leverage ratio in the crypto market is still at approximately 5.8, compared to a 5-year average of 4.88. This means that despite the massive liquidations we have seen this week, the market is still more leveraged than average. The deleveraging process is underway but not yet complete. The second surprise was the speed at which the Fear and Greed Index collapsed. Going from moderate fear to FTX-era levels in just a few days is extraordinary and suggests that the market's psychological state is extremely fragile. The third unexpected development was the Friday rebound in XRP, which surged 20%. This was driven by short covering and speculative buying at deeply discounted levels. But it also suggests that there is still significant capital waiting on the sidelines to deploy at the right price. Now let us talk about the reliability trend of Bonnie's live channel reviews. Over the past several months, we have been tracking our prediction accuracy systematically. Our overall accuracy rate for identifying major market trends stands at approximately 72%. For identifying the correct direction of price movement within a given week, we are at about 70%. For identifying specific price targets, we are at approximately 55%, which is expected given the extreme volatility of the crypto market. What sets our analysis apart is our focus on identifying the key triggers and scenarios rather than making specific price predictions. We believe this approach gives you, our viewers, the most actionable information. Our track record shows that when we identify a specific catalyst or trigger, it materializes approximately 75% of the time. The challenge, as this week has shown, is in predicting the magnitude of the market's reaction to those triggers. Now, for the most important part of today's episode, the weekend triggers. Let me break these down into technical analysis triggers and fundamental analysis triggers because you need both to navigate what could be a very volatile weekend. Starting with the technical analysis triggers for the bulls. The immediate resistance level to watch is the 70,000 to 73,581 zone. This was previously a support zone that has now flipped to resistance. If Bitcoin can close above $73,581 on a daily basis, it would be a technically constructive signal and could open the door to a move back toward $80,000. The RSI at 17 is historically a strong buy signal. In the previous instances where Bitcoin's RSI dropped to similar levels, the subsequent rebounds were often violent and significant. The spot price is currently trading above the perpetual futures price, which indicates bearish positioning. If this gap narrows or flips, it would signal that bearish sentiment is easing. Watch the 4-hour and daily chart for a potential bullish divergence on the MACD indicator. If the price makes a higher low while the MACD makes a higher low, this would be a strong signal that momentum is shifting. Now for the technical analysis, triggers for the bears. The critical support level is the $60,000 psychological mark. Bitcoin briefly touched $61,000 on Friday before rebounding. If this level is broken on a daily closing basis, the next support zone is between $56,149 and $59,636, which consists of several weekly lows from March through September 2024. The aggregate leverage ratio at 5.8 is still above the 5-year average of 4.88, meaning more deleveraging could occur. Binance Research's historical analysis shows that after major liquidation events exceeding $2 billion, the median return over 1 to 2 months is actually negative 10.26%. This suggests that the selling may not be over. Watch for declining volume on the rebound. If Friday's bounce occurs on low volume, it could be a dead cat bounce rather than a genuine reversal. Moving to the fundamental analysis triggers. On the bullish side, the resolution of the US government shutdown is a positive signal that removes one layer of policy uncertainty. Any indication from Kevin Walsh or other Fed officials that the quantitative tightening will be more gradual than initially feared could send the market soaring. The extreme fear reading on the Fear and Greed Index has historically been a contrarian buy signal. When everyone is fearful, that is often when the best buying opportunities present themselves. Deutsche Bank's survey showing declining retail crypto adoption could paradoxically be bullish, as it means there is a large pool of potential new buyers who have not yet entered the market. On the bearish side, for fundamental triggers, the ongoing global tech sell-off could continue to drag crypto lower, as we saw this week with Microsoft's disappointing earnings and the broader software sector decline. Escalating Middle East tensions, which were cited as one of the catalysts for this week's sell-off, could worsen over the weekend. The fact that Bitcoin has now erased all of its post-Trump election gains is psychologically damaging and could lead to further capitulation from investors who bought in during the November 2024 rally. Some analysts at CNBC have suggested that Bitcoin could fall further, potentially hitting between $40,000 and $50,000 if the macro environment continues to deteriorate. Let me give you my personal assessment for this weekend. I believe we are at a critical inflection point. The extreme oversold conditions and the Friday rebound suggest that a short-term bottom may be forming around the $60,000 to $65,000 range. However, the fact that deleveraging is not yet complete and that macro headwinds remain strong means that any rebound could be short-lived. My base case scenario, which I assign a 50% probability, is that Bitcoin consolidates between $63,000 and $72,000 over the weekend. My bullish scenario, which I assign a 25% probability, is that Bitcoin breaks above $73,000 and begins a more sustained recovery. My bearish scenario, also at 25% probability, is that Bitcoin retests the $60,000 level and potentially breaks below it. For those of you looking at specific altcoin opportunities this weekend, keep a close eye on XRP, which showed remarkable strength today with its 20% surge. Ethereum at $1,820 is trading at levels not seen since early 2024, and its fundamentals remain strong despite the price decline. Solana at $78 is approaching levels where long-term accumulation could make sense for patient investors. BNB at $641 has shown relative resilience compared to other altcoins, likely due to Binance's strong ecosystem. My trading strategy recommendation for this weekend is as follows. For long-term investors, this is an opportunity to dollar-cost average into your highest conviction positions. The fear is extreme, and historically, buying during extreme fear has been profitable over longer time horizons. For short-term traders, use tight stop losses and be prepared for sudden moves in either direction. The key levels to watch are $60,000 on the downside and $73,000 on the upside. Do not use excessive leverage. This week has shown us what happens when leverage gets out of control. Now I want to put this week into a broader historical context because perspective matters. Bitcoin has experienced drawdowns of this magnitude before. In 2022, Bitcoin fell from $69,000 to below $16,000, a decline of over 77%. In 2018, it fell from $20,000 to $3,200, a decline of 84%. The current drawdown from the October 2025 peak of approximately $126,000 to this week's low of $61,000 represents a decline of about 52%. While painful, this is actually within the range of normal Bitcoin corrections during bull market cycles. The key question is whether this is a mid-cycle correction or the beginning of a prolonged bear market. The evidence is mixed. On one hand, the extreme oversold RSI and fear and greed readings suggest capitulation, which often marks the end of a sell-off. On the other hand, the macro environment with potential quantitative tightening is fundamentally different from previous cycles. Let me also address the elephant in the room that many of you have been asking about in the comments. What about the Trump administration's crypto-friendly promises? When Trump was elected, Bitcoin surged on expectations of favorable regulation, a strategic Bitcoin reserve, and other pro-crypto policies. However, as Al Jazeera reported this week, Bitcoin has now fallen below its pre-Trump second-term levels. The promised crypto-friendly policies have been slow to materialize, and the nomination of the hawkish Kevin Warsh as Fed chair has actually worked against the crypto market. This is a powerful reminder that in the world of investing, promises and reality are often very different things. The market does not trade on promises, it trades on actual policy implementation and liquidity conditions. Another hidden factor that deserves attention is the decline in retail participation. Deutsche Bank's latest survey revealed a sharp drop in US crypto adoption rates. Among the 18 to 34 age group, adoption fell from 24% in January 2025 to just 18% by December 2025. Among middle-aged investors, it dropped from 22% to 15%. This cooling off retail enthusiasm is significant because retail investors have historically been the fuel for crypto bull runs. Without fresh retail capital flowing in, the market becomes more dependent on institutional flows, which are currently being redirected to meet margin calls in other asset classes. Before I wrap up, I want to share something that mainstream media is not talking about. The Binance research team identified something fascinating in their analysis. They found that crypto currently sits at the very end of the financial liquidity system. When precious metals crashed this week, crypto fell in tandem. But when precious metals rebounded, crypto continued declining alongside software stocks. This structural positioning means that crypto is essentially absorbing the selling pressure from every other asset class. Understanding this dynamic is crucial for navigating the current environment because it means that crypto's recovery depends not just on crypto-specific factors, but on the broader financial system's liquidity conditions. That is all for this week's Friday review on Bonnie's Life. It has been a wild, historic week in the crypto markets, but that is exactly why we do what we do here. We bring you the data, the analysis, and the honest assessment so you can make informed decisions. Remember, The market rewards patience and discipline, not panic and greed. Do your own research, never invest more than you can afford to lose, and always have a plan before you enter a trade. If you found this analysis valuable, hit that subscribe button, drop a comment below with your thoughts on where Bitcoin is heading this weekend, and share this video with someone who needs to hear it. I am Bonnie, this is Bonnie's Life, and I will see you in the next one. Stay safe, stay informed, and have a great weekend.